Yeah, thanks, Jeremy. So first of all, thanks everybody for joining, and you'll have to forgive me during the vacation. So I still was able to pick up some stuff, but normally the slide's a little bit bigger. I will say a few observations from being here in Tulum, Mexico. I was here about a year ago, and I noticed there was a huge construction boom going on, and this massive Airbnb market in this area, where I've heard there was one guy who actually rented, which led us into the Airbnb. So he signed leases for 20 different apartments and was Airbnb-ing all of them, on top of like massive construction that was happening everywhere. So now I'm here, and there are for rent signs everywhere. Everything is kind of empty. And besides some digital nomads that are in, and it's just interesting to see all the halted construction. So it's kind of interesting to see, kind of what's going to happen here. So it's kind of unique to see something from an ex-US perspective of how that's hitting a market that doesn't have as much government support and has incredible reliance on tourism.
Very cool. Very cool. Are you enjoying yourself?
Yeah. This is pretty cool. We've had some bad weather over the last few days, but today's been great.
Okay. Well, do you want to walk everybody through what you put together?
Let's do it.
Cool.
So I'm going to share my screen. Can everybody see the screen?
Yes, we can, Itay.
Yes, we can. All right. So I jumped a little bit around. So as we said before, we are Equilibrium Ventures. We have unique asset allocation with alts. We specialize in low volatility growth strategies. So still growth, but with low volatility and a lot of uncorrelated strategy ideas. All right, just wanted to get right into it, because I know we have a guest speaker with a lot of stuff to cover. Just want to go over the COVID-19 cases right now and a little bit about COVID. Basically, new cases have slowed down considerably, which is interesting because I haven't heard a lot in the news about it. When we look at deaths, about a month ago when we covered this and we saw the big surge in cases, a lot were calling for a big increase in deaths that is going to follow. There were some talks about further quarantines, and we said, well, let's just wait and see if deaths pick up with the new cases. And so far, fortunately, they have not. We've seen a slight increase in deaths, but nothing too major. So I thought that was kind of interesting. Looking at even one of the most problematic states, which is where Jeremy is right now, Texas.
Rob is here too.
That's correct. Daily new cases have slowed down, but also total active cases have seemed to have peaked up so far. And I found that to be quite interesting as well. So as of right now, at least, that reduces the likelihood of further quarantines, which maybe is one of the reasons the markets are continuing their upward move. Now, let's talk a little bit about the vaccine situation. Right now, there are 6 different companies that are in phase 3 trials. Apparently, Russia already has a vaccine, but I don't know how trustworthy that is, or at least that's what we hear from what we have in the West and China.
I think Putin tried on one of his political opponents.
Or that was his daughter, right? He said, my daughter had it. He didn't say which one. There's one he doesn't like.
Oh, boy. Oh, boy.
All right. So the University of Oxford AstraZeneca is most likely the leading vaccine right now. And this is actually interesting. I took this out of Deutsche Bank, trying to figure out where they're at. So they're aiming to produce 2 billion doses of the vaccine, including 400 million in the US and UK. What's interesting is they're planning to start distributing those in September or October. And deliveries will be made in early 2021. This is depending on the success of phase 3 in August. And from what I've heard, it's fairly successful, but they have not announced anything as of yet. I find that quite interesting because their plan to start distributing the vaccine is very, very soon. But here's what's kind of interesting on that front was, if there was a vaccine, would you even take it? So this is a survey they've done in various countries. So for example, in the US, even if a vaccine was mandatory by law, 36% would not take it. In Russia, which apparently they already have the vaccine, half of the people don't want to take it. So the big question is, even if there was a vaccine that was relatively effective, would people actually take it, and would it cause a large change? Either way, I'm pretty sure the market would like it. So this was the research coming out of Goldman, based on their baseline right now is that there will be a vaccine approval in late 2020. So they're expecting mid-2021 to have GDP coming back to pre-virus levels. And if there's no vaccine, then we'll be in a more thorough contraction, but that's no longer the baseline based on the information that they have regarding the vaccine. And I think we've seen the market pricing that in, or we've seen at least a part of the market. We'll talk a little bit about that. Okay, so I wanted to cover debt because I know we're going to have an alt debt presentation today. So I think it's worth speaking about public market debt for a little bit and kind of see where it is. We've seen the largest discrepancy and break of correlation in the public debt markets we've basically ever seen. In light blue, you can see the total bankruptcies of public companies with more than $50 million in debt based on Bloomberg here. And the dark blue is essentially the average yield. So as expected, if there are more bankruptcies, investors are going to want or demand higher yields in order to fund those companies. And that's been very tightly correlated over the past 20 years, but we've actually seen declared bankruptcies exceeding 2008 levels, and the yield has dramatically fallen. And this is no longer tracking one another, which is quite interesting.
So does this tell you that this is just the Fed buying everything?
The Fed is kind of buying everything, including junk bonds. So the Fed has announced that they will monetize high yield debt if needed, and they have done some of that. So I think they've essentially broken this correlation because the market is no longer worried about the bankruptcies, knowing that the Fed is essentially injecting a lot of free money, and also interest rates being as low as they are. This is actually the next slide, titled "Money is Free." So why don't we just borrow more of it? We can see here is that pink? Yeah, it's pink. So in pink, you see the kind of like high yield companies have over 5x their earnings in borrowing, where the investment grade have also now been in about 3.5 times, where historically they've been well under 3. So they're definitely taking advantage of this. What is interesting though is because the interest expense is so low today, companies' earnings relative to the interest expense are actually low. So for investment grade and for high yield both, you can actually see that the amount of money out of their earnings that they're paying for interest has dropped. So even though they've borrowed a lot more money, they essentially pay a smaller portion of their earnings to sustain that debt. Because if you think about it, if I told you, hey, I'll lend you $1 million, and all you have to do is pay me $500 a year for it, you would take that $1 million, right?
Absolutely.
So that is kind of the situation that we're seeing right now.
So then let's say this is happening. Like, what are the implications from your perspective 5 to 10 years from now as these companies just load up on debt?
Well, that debt is not going to go away. They're going to have to eventually roll it over, or they're going to have to pay it down. So I think they're going to want a lot of inflation because if they have inflation, that debt is going to get inflated away over time. But the biggest risk to all this is a sustainable increase in interest rates somewhere down the line. Because imagine, even if these were 10-year notes or 5-year notes and they come due in 5 years, they need to issue new debt in order to roll this over. And if interest rates are higher at that time, this could really, really backfire somewhere down the line.
Got it. Cool.
And another interesting impact that is going on in the markets right now, especially in 2020, is what I call S&P 5. So the total S&P 500, out of that total S&P 500, the 5 largest companies right now are nearly a quarter of the entire market. And the 10 largest companies are 29%, which literally means like the entire growth we're seeing in stocks right now is concentrated in very, very few stocks, creating a very, very interesting market. This is actually higher concentration than we've seen during dot-com bubble and goes back all the way into the 1980s to see anything even close to that. But even now it's exceeded even that. This is kind of interesting as well. This is just an example of a trading week, last trading week. So equal weighted S&P. So if imagine each stock carried the same weight versus the broad S&P. So you can really see how much divergence there is between the bigger stock market and the focused stock market.
So you're basically saying, hey, the majority of these companies are actually down, but there's such a big gain, which is really just being brought up by a few.
Right. And you can actually see that the correlation between an indicator that was extremely correlated with the stock market, which is new 52-week highs to the S&P 500 is no longer tracking at all. New 52-week high. So basically, as the market goes up, you would expect more and more companies to make new annual highs. As you can see, it's a pretty healthy indicator that as the stock market rises, the broad economy participates in it. And we've seen an increase all the way back to the same highs, and we actually exceeded all-time highs today in trading. So the market has gone back to those same levels, but there's very few stocks that are actually making those 52-week highs. And that's actually one of the weirdest markets we've ever seen. And to illustrate that even further, here is again from Goldman Research. This is 2020. So the S&P 500 for the year now is up 2%. Facebook, Amazon, Apple, Microsoft, and Google, the biggest 5, are up a stunning 35% for the year, where the entire 495 stocks are actually down 5%.
Got it. That's actually an insane stat to see.
Right. And there's a large premium right now for just liquidity and size. A lot of it has to do with the vanguarding of the market, but I also think a lot of it has to do with the unfair ability to borrow money for nothing. So with that said, this is all I have for today. So let's open up for any questions on my side.
Hey, could you go back 2 slides where it said the 5 versus the 495?
Sure. Let me try.
And don't blame Mexico 3G internet speeds. I don't want to hear about it.
This is exactly what's happening right now. There you go.
Okay, so is this not the top 5 stocks versus the 495 stocks if you equally weight them or if they're cap weighted?
So cap weighted would be in the green, meaning like the normal S&P 500, and here would be an equal weighted S&P 500.
Okay, I was just kind of wondering why I was saying the 5 versus the 495. Then
yeah, the headline is not representative of that chart. That's actually for the future one, but this is just cap weighted versus equal weighted.
Okay, so that was like the later on caveats that could cause blindness, deafness, or anal leakage or something like that. So that's what you're telling me?
Yeah.
Okay.
Very cool. So Itay, these 5 companies, how does this impact everybody's portfolio since everybody has exposure to these companies?
Well, it means that, first of all, if you didn't have exposure to these companies, you haven't done very well this year. But if you did, you don't need the other 495, technically speaking. But the idea is just risk is significantly higher when all the gains are concentrated in just 5 stocks, just because nobody else is really participating. Because if something happens to those 5 stocks for whatever reason, or there's some regulatory changes, right now would probably be the biggest risk. If something like that were to happen, the S&P would be in big trouble.
That makes sense. So if it's in my portfolio and I wanted to see what type of risk I have, are there any third-party tools that I could use that could potentially help me understand like how much correlation I have or overlap between some of my holdings?
If you add a Bloomberg terminal, you can run the CORR application that you can run correlation matrix.
I only need like what, 10,000 a month to do that?
2,500 a month.
2,500. Okay, but if I want the free 99 version, how am I going to do that?
If you have an account in Interactive Brokers, they have a really good portfolio analyst tool. So I know a lot of people own different mutual funds and they think they're diversified with all the mutual funds that they have. And their portfolio analyst tool can actually show you concentration risks across mutual funds. So you may own mutual funds and you're thinking, I'm investing in all these different things, and you realize you actually have 20% Apple. So that's actually a very common thing that happens. On the flip side, again, if you didn't have 20% Apple, you probably wouldn't do nearly as good as you have this year. So it's a double-edged sword. What goes on right now, but at least you would know that that's the risk you're carrying. If you're an option trader, you can potentially even hedge that with Apple puts or whatever it is versus S&P puts, because there's no S&P anymore, right? It's just 5 stocks.
That is very true. Any other questions? I know you guys are all thinking something. What's on your mind? I think even though you're the one in Mexico, I think everybody has drank a few too many tequilas today, or maybe it was yesterday or this weekend, and they're just sleeping in. So we're gonna have to have Nelson really gear them up, because you and me have failed today. We're not doing our thing.
Yeah, somebody actually left a bottle of tequila at in the fridge here at the Airbnb that I'm staying.
So
okay.
I guess the question would be is, where do you see then from this point out on the S&P? Predict the future.
Predicting the future is difficult to do. If I could effectively do it, I'd probably own Mexico instead of just going there, right? But nonetheless, I think it's a mix of things, and I think these trends can last for quite some time. I do see it as a very important risk that it's very important to track these 5 stocks and track the changes in the real economy, because I think that's going to give you a lot of foresight into what can happen. Nothing, of course, is guaranteed.
You had Mike Dever do a presentation. I think his son's on here tonight. And one of the things he's built into his hedge fund and CTA, CPO type stuff is he provides hedging for portfolios. And that's what he's kind of built his business around, is so just the unexpected when the markets go haywire. And, you pay somewhat of a premium for that, but you can smooth out your equity curve and you can sleep at night. So I know it's one of the things that he's done. And I think Larry Abram, that's also on this call, provides a lot of crisis alpha for what he's doing. So.
Yeah, absolutely. And as we talked about, avoid those drawdowns, and that can lead to the gains over time. Anyways, so I got
something else too.
Please hop in.
It will be the 6th, because Tesla's supposed to be going into the S&P 500 soon. And that thing, it doesn't do 35% a year, it does 35% a week. So, and that thing's huge.
Yeah,
well,
that one's insane.
Tesla's like 1,000 times earnings right now or something like that.
Yeah, but you know how that is.
Tesla just reminds me of all the private tech companies that you see and the valuations that they pull just on a public market level.
Well, Robinhood has a lot to do with the way the markets have been trading in 2020. And, I think it has more impact than people think. And,
Hey, Alex, what sector would to go in? Is that just industrial? Is that automotive?
I'm not sure which one they're going to put it into because I don't think they've sent out the official thing yet. But I don't know. Is it automotive? Is it batteries? I don't know.
Or technology? I mean,
it's supposedly a technology company, but it's really not.
Right. So,
yeah. But when they build the Gigafactory here in Austin, we will tell you what they are positioning themselves as.
I think by that time, Jeremy living in Austin.
You cut out. You want to say that again?
I say by that time, you're probably not going to be living in Austin the way it's going right now.
Yeah, there are certain things happening in Austin for the good and for the bad. So kind of like how everything is. Anyways, so real quick, everybody, I do want to transition quickly to our guest speaker. And Itay, I will tell you which of his logins to make the host in a minute. But our guest speaker is a superstar in this alt investment space. His name is Nelson Chu. He's the founder of WithCadence.io. They're a private credit alt platform that has already seen over 138 million invested, and they're shaking up the whole industry. I was fortunate enough to get to see his presentation before. He is a good speaker. He has done this before, and he's a smart guy. So we're very, very lucky to have him on, and he's going to teach us all about private credit markets. So Itay, your job real quick is to find Nelson's, find him on the list. There is one that is a non-video, and you can make that the host. Okay.
Yeah, I already allowed anybody to share, so we're good there.
Oh, okay, cool. So Nelson, you want to say hi to everybody?
Yeah, absolutely. Hey everyone, thanks for having me on. Really excited to go through this. It's a pretty nice segue from last week, or 2 weeks ago rather, when we talked about kind of alts as a whole. This time we're digging into one specific category of alts, which is private credit. And it is one that people are dying to get into right now. They've been dying to get into it for the last 10 years. So it is definitely uncorrelated alpha through and through. And so it's should be hopefully a fun conversation. I would say,
cool.
If you have any questions throughout this process, feel free to chime in. Happy to kind of address them on the fly if you see anything you want to learn more about. Otherwise, we'll just keep going. So just
I'll budge in super quick. Nelson is on a roll. He moves fast and he's got great stuff. So Nelson, I'll probably slow you down every few minutes.
Sure.
You can just open it up. But everybody, you've got the little chat right there. You can also ask a question. Just feel free to go in there. Okay.
Cool. All right. So here we're going to talk about how to build a more efficient private credit market. So just to kind of level set for everybody, private credit is a bit of a catch-all when it comes to sort of the alt space. There's things like private equity, there's venture capital, real estate, infrastructure, and private credit specifically is very much more of a kind of like small business lending, consumer lending, factored receivables. It's really a lot of what powers the economy today, especially for the smaller companies out there. And it kind of doesn't really get talked about all that often. And there's a lot of reasons for that, which we can dive into. But you know, there's been a pretty crazy shift in private credit specifically. It's been on a pretty much 20% compound annual growth rate since 2000. It is by far the fastest growing asset class in all private capital markets. And there's a couple of things that have spurred that. First and foremost, we've had now 2 crises in the last, call it 10, 12 years. One was the global financial crisis in 08, 09. And that was essentially a time when the banks all stopped lending, right? They all pared back, whether it's because of regulatory requirements or just kind of wanting to not spend so much time on small businesses because there's just too much effort. They all basically stopped lending to this audience, your small businesses, your consumers, things like that. And that's led to a bunch of different people that have come in to fill that void. A lot of them are fintech companies, a lot of them are non-bank lenders, and it's contributed to this massive, massive growth. We're seeing that again with COVID. It's actually gotten even worse. So the banks have pretty much just stopped altogether to small businesses. And you can see even with like the PPP loans, Chase got into a lot of hot water because they didn't want to touch anyone that was smaller. And they just went after a Shake Shack and, you know, Ruth's Chris and all the big guys because it's just a lot easier. They'll make a lot more fees that way. But you're in a situation now where a lot of these small companies, a lot of them are VC-backed companies, are the ones who stepped in, replaced the banks effectively, and now have been providing capital to this part of the economy that's really underserved or even unserved altogether. So what's interesting about this is that private credit as a market is actually about 2/3 of it is made up of sub $50 million EBITDA companies. So naturally a little bit smaller. And actually what you can't see here is that about 1/3 of it is made up of sub $5 million EBITDA companies. So even smaller. And that makes up a huge, huge chunk of this marketplace. When you have small companies, then you just have a lot more problems, right? You have people who want to invest in these opportunities, invest in these products and these assets that just can't find them at the end of the day. So 85% of the time spent by a portfolio manager for private credit is actually spent trying to find the deal, if they can even get it all together, and also spent diligencing that deal. So they're only spending 15% of their time actually doing their job of portfolio management. And worse than that, about 40% of the deals actually come from direct relationships. So this is a $1 trillion market pretty much bankrolled by people that you know effectively, which is just not efficient, not scalable, or anything like that. And so this is the $1 trillion problem, right? So you have lenders, non-bank lenders who have stepped in, who have, are fintech companies, very data-driven, that are trying to support small businesses and consumers, and they just don't have access to capital to be able to grow and scale. In the meantime, you have all your usual suspects, your asset managers, your insurance companies, pension funds, family offices. All of them are looking for private credit exposure right now. It's the only place you can get yield. They need to diversify away from the crazy stock market dominated by 5 companies. All of that is contributing to a world where they're looking to get uncorrelated returns that are much more predictable, which is what private credit is supposed to be able to do. And so, the larger side of the market, called the middle as well as the large end, is pretty well serviced on the debt side. You have your BDCs, your banks that do actually continue to serve the larger debt markets, middle market lending. But on the smaller side, there's really nothing here at all. This is the direct relationship puzzle that that's causing all the problems. And on the equity side, this is kind of pretty well serviced from end to end, whether it's VC, private equity, or public markets. There is a solution for companies out there. So this is the pain point through and through. And so in a situation today, you have lenders that are going to be going out to the 4 people that they know and hoping that one of them is going to give them a warehouse facility or a term sheet or something like that to give them the capital they need. And they're leaving hundreds, if not thousands, of different investors out there who would be interested in these products and just don't know who they are and can't find them. So at the end of the day, you now have, this is really the real problem here. That $1 trillion market today has about $367 billion sitting in dry powder. It's cash earmarked for these investments. If only there was a way to find the deals, if only there was a way to efficiently diligence these deals and ultimately invest in these deals. How do you make this more efficient from top to bottom?
So Nelson, I have a question.
Sure.
So you could have $350 billion in sideline money here, but do you have any concept of what is the demand in terms of total cash from this segment of the market that they want to get? Like, what's the mismatch of demand needed and supply of cash that's still out there looking for that?
And let me add a little bit more to the question, because I think your data here is from 2019, but 2020 changed rapidly. So we know that M2 money supply grew by 23% this year, and there's I think $5 or $6 trillion literally more in the systems. Do you have any idea of where the supply demand is right now? Because I would assume business demand has grown as well.
Yeah, so that's the tricky part. So there hasn't been any studies done through COVID, obviously, because it's relatively recent. The initial projections for 2020 was looking at about 1.1 or 1.2 trillion in terms of market size, and about 400 billion plus. So it's also, the dry powder has grown substantially since then. And the truth is, some of that money is designed to be earmarked for cash just in general. Like, they need to have some cash allocation, but the bulk of that needs to be deployed. Like, they need to find more deals. And so what's been the challenge is going down market, right? So when we kind of looked at this slide earlier, all of these guys have been investing over here, and that's where they've been putting their money. But nowadays, everyone's trying to go further and further down market, because that's where all the deals are, and that's where all the problem lies. There's no ability to actually properly, efficiently diligence this side of the market because there's no standardized data at all around that. So it's a ton of effort to get there. So if you have a platform or system that can push out volume in terms of data, transparency, and all of that, then you can actually put that money to work. So most of that 367 billion, and soon to be, call it this year, about 400 billion plus, is earmarked to actually go into these assets if they can find them, basically.
And Nelson, I got a question. I don't know if you're covering this. I forget if you're covering this or not. Do you have any idea of what the returns of this category look like in comparison to some of the other larger credit markets?
Yeah, sure. So it's commensurate with the risk that you take, right? So inevitably, if you're going for, investment grade corporate credit, you're not going to get a whole lot of yield, right? But people like pension funds just want that all day, every day. But in an environment where these pension funds also now have hurdle rates that they have to clear, where basically they've promised they're going to get at least this return, right? Corporate credit is not delivering where they're supposed to. And so they've shifted a lot of that allocation to private credit to compensate for that. So private credit in the, call it the rated space, whether it's, single B, double B, triple B, and IG, those are yielding anywhere from, I would say, 4 to 12%-ish. You can probably get there. That's around the ballpark. That's a pretty wide range. Investment grade generally means it's below 6, effectively. That's pretty conventional. And anything above that is going to be single B, triple C, or something like that. So yeah.
Cool.
So
thank you.
In my slide, I showed a little bit how on at least the public debt market, bankruptcies and effective yields this year just literally stopped being correlated because the Fed said we're buying investment grade and high yield bonds. They effectively said that, right?
Mm-hmm.
And that broke the correlation because essentially there's no risk, right? So I know we're saying that, but these are things that actually happen, right? We've seen the first time ever correlation is broken. So investors are thinking, I don't have risk because this company will just be bought by the Fed. Effectively, they're too big to fail. Too big to fail is expanded to a lot more companies than it used to. So my question, if in your field, you're still seeing the real economic relationship between risk and return, that has not broken, unlike traditional public markets where we're actually seeing that getting broken.
Actually, so it's interesting you bring that up because we have, we can dive into a lot more of this later. I don't want to talk too much about what we do specifically, but we really have two cohorts, right? We have retail audiences and we have institutional audiences, right? And so our retail platform is what you see on our website right now. And during COVID, we launched a Dutch auction feature, basically, that allowed the retail investors, to set the price of what they would be willing to take in terms of yield for them to continue to give money to the platform, basically. So things that were yielding 12% originally spiked to 16%. Things that were yielding 8.5% spiked to 12% because there's inherent risk now with these investments that they want to be able to price in. And that was in March, April of this year. So because our stuff is so short duration, we can react very quickly. And so as we've gone through a couple more vintages, like COVID vintages, the yield that was 16% now dropped back down to about 13. So we're still slightly above pre-COVID, but we're still we're pretty much there, which is pretty impressive, all things considered. And you've also seen the ones that were at 8% jump up to 12%. Now they're below where they were during COVID, pre-COVID, because people are like, wow, they weathered that perfectly fine, so they must be great. So you're seeing that happen on the retail side. On the institutional side, definitely still risk there. And I think they tend to be savvier investors just in general. And so you've seen the yields that spike up and they haven't really come down dramatically, I would say. It's gotten better for sure. And sector by sector, it's all different. So for example, we did a deal in the restaurant franchise business. That is a tricky spot to be in. And then there's also ones in the small business lending space, also tricky to be in. But then when you're talking about factored receivables, where you're basically just paying off, you're deferring basically or fronting the money for a Costco or Walmart or Whole Foods to pay you later, right? That's very little risk, and that has performed relatively well all throughout. So it really just depends on the sector and the company. But I would say institutional definitely has spiked and pretty much been still a little bit higher than it was pre-COVID.
Awesome,
cool. Do you want to continue in the presentation?
Yeah, sure. So this is the challenge, right? If you're going to try and deploy $400 billion, you're not going to be able to do it through retail investors like you and I. It has to be done through institutions, and institutions do and access the capital markets side of the world, and specifically in our world, securitization, which we can talk about in a little bit. But let's go through kind of each of these 4 different transaction parties in here. The lenders themselves, we talked about this already, have a trouble getting financing and access to the traditional markets, right? They're usually too small. And so that side of the market doesn't know how to deal with a deal that small. And if they can't or aren't really tech enabled, then it's just gonna be really expensive for them to operate. So if I can't give you the data that you need, then you're just gonna give me very expensive capital at the end of the day. But the buy side, that is the, call it $400 billion burning hole in their pocket that needs to be put to work. So they're always searching for deal flow, and they're being forced to go down market where they're not comfortable and they don't have the conviction around it because the data is not there. And the effort required to diligence it is just really high. It's a lot of work, and they're somewhat not inclined to do it. And now you also have other people who are ancillary to the transaction, like the banks. The banks, obviously, like I showed earlier, service that kind of middle and large side pretty well. They've done a terrible job on the small side. And so these teams are looking for new assets. Everything else is pretty mature at that point. But the amount of effort today to do a $500 million deal is the same as the effort to take a $50 million deal. So there's no point in doing a $50 million deal at the end of the day. And same thing goes to ratings agencies. They have a bunch of overhead costs that it takes to actually do a deal and rate the deal and do all that, the work that they put into it. And so when if a fee is like $125K to do a $40 million deal, doesn't really make a whole lot of sense. So all these guys are struggling with the data side of the world. And so there is a significant opportunity here to actually really streamline that from end to end. So this end-to-end solution can change anything from discovery to diligence to investment, all underpinned by data. So just real quick, diving into each of those. On the sourcing front, it's pretty simple, right? This is just all the assets you want to put into a product. And the investors themselves, the institutions, are accustomed to buying not just one loan, for example. They'd rather buy 50 or 100 different loans because it de-risks it. So same way as you'd rather lend to 50 of your friends than just one of your friends, because if one of your friends doesn't want to pay you back, then you're still kind of generally okay. Same concept here. And so when you securitize something, you would group the assets based upon the risk, and you would create different tranches. And someone here would be able to actually verify that for you. So ratings agencies would say, okay, you tranche this properly. This basket of assets is going to be lower risk. This one is medium risk, and this one is high risk. And at that point, you'll have the ability to send it out to all the investors who are interested. I would say, insurance companies, pension funds like to go for the low risk stuff. This is investment grade. You have your credit funds and your hedge funds and your family offices that go for the medium stuff. And then, there's always a buyer for junk stuff. That'll always be there. But yeah, so this is sort of the process from start to finish. So first and foremost, kind of if it's going to be garbage in, garbage out. So you have to actually resolve that initial piece of the puzzle. So right now, today, there is no standardized single source of truth for asset performance. And if you don't have that, then you have no ability to kind of get all these guys involved. So if you had the ability to create some sort of database that could actually get the data from the lenders and then ultimately package it up and syndicate it and structure it in a way that is useful and usable for all these different counterparties, you can make a really efficient market. And so this wasn't really possible, I would say, in 2009, like in the last financial crisis. But Tori presented a couple weeks ago around sort of how mature the fintech ecosystem has become, specifically around the infrastructure side of things. You have solutions that actually let you track payments, like what actually was paid off, who did it come from. You have the ability to actually pull money automatically, algorithmically through APIs. All that's there. So if you think about this is a loan kind of from a lender, right? You can actually get the funded amount, the APY, the business type, the state, that all comes from them. Some of this stuff is calculations, but the truth is you can actually see when they got their payment from their borrower, and then you can see when they made the payment to you, and you can actually even pull that information. So if you look at all of this stuff here, none of this stuff is that complicated. And this stuff simply doesn't really exist today in one place, at the very least. All of this can be done through the fintech solutions that are out there, through calculations, or through your own APIs that can actually grab this information from them. So you can actually turn any low-tech lender into a tech-enabled one, which means that if you can do that, you have the ability to bring them out to the traditional capital markets.
So Nelson, then why don't some of these big banks that have the funding just say, hey, I'm going to throw an engineering team on this. They'll connect all these different data endpoints, and now I can become better on the tech side and go after this cohort.
Because 15 years later, it'll finally be finished, basically. That's kind of the truth with banks, unfortunately. And they've been.
I can tell you how true that really is, and what old and garbage systems they were using. It's unbelievable.
Yeah. And
so it's basically so then it's like this is why it's the startup companies. It's people who run really lean, that understand tech, who aren't burdened by all of these internal processes that can spin together the newest APIs, bring in Plaid, bring in all these other places, who have a chance at the market and thus have an opportunity to get some returns that the rest of the market may not get.
Exactly. Yeah. And if you think about it, like from a bank's perspective, look, I make, call it 1.25%, 1.5%, or 2% off a transaction, right? I'm willing to give up 15, 20 bips on that just to be able to basically use someone else's tech that I don't have to build, and I can use it next year, right? Or next month. Like that is, it's found revenue for them. So it's significantly more opportunistic for them to just leverage someone else than it is to try and do it themselves. And just like we mentioned earlier, it takes forever for them. They're built on really legacy systems. They have not changed them. And it just takes a lot of effort, and it's not worth their time at the end of the day. They'd rather just get the revenue now.
Makes total sense.
Cool. So with that data, if you have good data coming in, then you can also actually monitor the performance and package it up in a way that's actually very powerful. So surveillance reporting is, think of it as like if you have a Charles Schwab account or a Fidelity account or whatever, is the analytics around your underlying investment, your portfolio, right? So you can actually do that for all these lenders as well. You can break it down by state, you can break it down by sector or industry. You can see in this instance, we have a pre-COVID vintage and a post-COVID vintage. All that stuff is here that's relatively new. But it's things that you can provide that as an investor who's looking for this data, who normally can get it from the public markets on a more frequent basis, doesn't actually have access to it on the private markets, or even on the smaller side of the private markets. This is game changing for them. They actually now have the ability to monitor the performance of an investment, which just wasn't possible before. So all told, this data aggregation and standardization happens, is valuable at the very beginning when you're just even vetting the originator, the lender, seeing how they're doing, seeing if they're qualified and how they're performing, to actually doing the credit analysis on the portfolio and seeing if you can make a product out of it. And ultimately, after a product has been made and invested into, you can actually monitor the program and the entire portfolio on an ongoing basis. So this is something that data can fundamentally transform in private credit. And it's never been possible until very recently with the rise of a fintech solution for everybody, or anything, basically.
And so, Nelson, from your experience, which of the fintech products has been most important in this revolution, and why?
Yeah, it's all the unicorns, actually, probably. So Plaid has done really well, the ability to actually connect bank accounts. And so, for example, as a lender, you can have your borrower connect their bank account, and now you can see when the borrower got paid for a specific invoice. And the moment that gets paid, you pull the money, right? So Dawala helps you pull the money. So those two together have transformed how underwriting is done at a much more like foundational level. It's also the reason why you see companies like Stripe going into lending, because they have so much data around point of sale transactions, or even online transactions for these merchants. So they have the ability to say, okay, well, theoretically, I've seen your sales go like this for the last 6 months. So I'm comfortable advancing you X% off of future transactions because I just know all this about you. I know where your buyers are from. I know, what you normally sell. I know what your inventory looks like. All that stuff is in their hands. And so it becomes very powerful. So they've also done a really good job. But yeah, the ones that become unicorns are the ones that people are relying upon at the end of the day. And they've done a really, really good job of making the ecosystem much more mature.
Great, thank you. And do you want to open it up real quick and just say, are there any other questions? I know we haven't opened it to everybody. Just want to take a pulse of where everybody's at.
Min and max investment?
For us as a platform, or just generally on average?
just generally on average. So if Matthew Dever there, he's a college kid, he wants to get in for $1,000. I mean, is he able to do that? I mean, what's your minimum max there?
Yeah, so when it comes to private credit traditionally, their minimum threshold is about 500K usually. So it's usually family offices trying to get into a fund or something like that. But when it comes to these new crowdfunding platforms, similar to what our retail platform is offering, the minimums are a lot lower. So I think some of them have gone down to like $5,000, $1,000. For us in particular, we have the lowest minimums in the industry, so it's about $500. The only caveat is that you will have to be accredited, and so accredited means $250K in annual salary or $1 million liquid assets. So it does change things. But the rationale for offering a low minimum is that it lets you try things out, right? So you don't actually have to put a lot on the line, and then you can actually see if it comes back or not.
I mean, when I hear $500 minimum, I think of your job as your credit type stuff.
What do you mean by your job as your credit?
Oh, you've apparently never been to a pawn shop, so.
I have not, unfortunately. Sorry about that, but yeah. No, so it's the minimums for the retail platforms are a lot lower these days, but some of them require formal accreditation. There's ways to structure it so you can take any investor, but to take any investor, it's a lot more regulatory headaches, basically, because the SEC wants to make sure that you're not, basically trying to scam a bunch of people because you're going after Main Street and mom and pops and things like that. Any other questions?
No, but Nelson, when you do finish, I do want you to show everybody what you're working on, because I think it's super interesting and is a great opportunity to make some money.
Yeah, absolutely.
And improve a portfolio.
Sure, for sure. So moving on, if we have good data coming in, then all the other sequence of events becomes a lot simpler, right? So securitization, just as a recap, takes all these assets and puts it into a product and tranches it out. So it actually contributes to so much of what you and I, all of us kind of interact with on a day-to-day basis. But assets that can be securitized, it's your mortgages, auto loans, student loans, royalties, equipment leasing, solar construction, like anything generally, as long as there is some sort of cash flow coming out of it, can actually be put into a product. And if you think about it from a bank's perspective, it's like zero risk for them, right? Like I will do all the work and find all these assets, put them all together, and I'm going to send it to somebody else to buy it. So welcome to 0809, basically. But they've gotten a lot better, and there's a lot more regulations in place to protect the investor at the end of the day, much more so than it was back then. But mortgages are probably the most frequently known one. It's like mortgage-backed securities, commercial mortgage-backed securities. That is a massive, massive market. You're seeing auto loans rise up. Student loans have become a huge sticking point these days. That has definitely almost all of it has been sold out to investors. So pretty much anything with interest can have securitization attached behind it. So it actually finances 30% of the annual U.S. debt capital markets. It's an obscenely high number, 2.4 trillion on a yearly basis. And even for kind of direct interaction with all of us, it actually funds 50% of U.S. household debt, whether it's your mortgages, whether it's your student loans, or whatever it is. It's all kind of here. So it is very much a part of our everyday lives, whether you know it or not. So going into phases of securitization specifically, this is sort of what we talked about in a little bit more detail than those kind of 5-step process. But you can see how much data plays a role in each of these, right? So if you have the data around it, then you can actually do proper origination, proper underwriting around the lender themselves to understand how they're performing. On an ongoing basis, you see them service the loans. You can actually get the performance out of that to be able to determine how your investment or your product is doing. As a structurer or a securitizer, you can go in there and basically create the product based on what you understand about that underlying performance. The ratings agency has the ability to actually understand and synthesize the data coming out of it to give it a proper rating, no matter how big or large or small the portfolio is. And ultimately, investors have the ability to actually find the opportunity, invest in it based on what they understand about how the portfolio is doing. And then ongoing, after the investment product has been made and invested into and it's maturing, the ratings agency can again step in and monitor how it's doing. They can maintain compliance and reporting and the surveillance that we talked about, and obviously continue to service the asset if there's any issues with the actual product. So if all goes according to plan, you can actually have a brand new paradigm for private credit built upon transparency and efficiency that you see in public markets more often than you see in private markets. But now is as good a time as any to have something like this. And so you're in a world where lenders can access capital very quickly, very easily. You have banks that can actually due diligence these assets and actually go into a smaller side of the market. You have ratings agencies that can do full diligence on the borrowers and the assets they couldn't do before. And you have the buy side that can put 400 billion to work effectively. So you have a very kind of nice ecosystem here where every counterparty is talking to one another, which is fantastic. So yeah, that's kind of private credit and securitization in a nutshell. But to Jeremy's point earlier, we can talk a little bit about what we do, because we do try and solve a lot of those pain points we talked about. So these are the various different lenders that we've worked with over the past year that we've been around. Our platform went live in July of last year. And you can see it's a pretty broad mix, right? So we have Amazon merchant, working capital financing, small business lenders, mobile app developer factoring, Mexico, Colombia over here, power sports like motorcycles, solar construction, logistics factoring, crypto, point of sale financing. It's a really, really broad mix. And like I mentioned earlier, they all have cash flows coming out of it. And so if you have cash flows, we can securitize it at the end of the day.
So let's talk about that a little bit more. So the underwriting criteria that you have when you're looking at some of these businesses, even like, some of these like crypto ones, like what's your process to make sure that that these are a worthwhile investment and something that is worthy of being on your platform?
Yeah, so we actually have, an entire capital markets team dedicated towards, on the retail side, finding these originators, properly underwriting them, diligencing them, and ultimately syndicating it out. The retail platform is risky, right? Like basically it's our reputation on the line. And so that has to be the highest of high quality lenders that we ever put on that platform, even though we see hundreds of them. On the institutional side, there's more, because it oftentimes gets rated, there's more protection in place naturally, just because it's a true asset-backed securitization that you can throw in there that, you can control the cash. There's like escrow accounts. There's all these different things that you have that ultimately are there to protect the investor that you can't do on the retail side. It's just not possible. So we have a very, very rigid underwriting process on the retail side. So we have over 130 data points that we look at when it comes to these lenders in terms of how to get comfortable with them, at least to get them on board. We spend a ton of time analyzing the loan tape that they give us. We oftentimes try and run models against it to see how it would perform. COVID is, no model predicted COVID. So, zero cash flows for 3 months is a very different world than most anyone is used to. But we weathered the storm pretty nicely, all things considered. And it's a credit to our capital markets team for being able to do that. But yeah, so we have 12 right now. 14 right now. This is as of July. So we launched 2 in August. And we're looking at probably a couple more through the end of the year, and just all very diversified asset classes.
Got it. And I don't know anything about regulatory concerns, but do you personally or via an investing arm make any of your own personal investments into these companies?
Yeah, so our balance sheet does get put to work for every single deal that we do. Granted, it's not a huge amount, but it is some. But if there is a situation where we see it potentially is going to go into a workout situation where the assets aren't performing as expected, our committee comes together, our investment committee comes together and determines how much we want to put in to basically show our investors we have skin in the game, just along with them. So the incentives are all aligned. So we had to do that before, and it's something we'll continue to do going forward because retail investors is very much, you, me, our parents, like they're putting money to work here. And we want to make sure that it is as sound as it could possibly be.
What was the COVID default rate throughout the platform?
We have 2.07% right now in terms of our entire portfolio. So that is significantly lower than the rest of the industry. We were almost so close to making it zero, but it was one of them had to go into a workout because they couldn't last 3 months without any cash flow essentially. But yeah, we were almost very, very close to having no defaults.
2% is phenomenal.
Yeah, it's significantly better than the rest of the industry. The average is like about 15%, I would say, and some of them are a lot higher than that. And they, you can earn 60%, but your default rate is like 30%, in which case, you net out to you know, it's a bit of a wash, but yeah.
What do you attribute that to? You had very little hospitality?
No, we definitely had some. So here's the interesting part about lending. So if you're comfortable with the lender, if you believe they're very tech enabled, if you believe that they have, they're the kind of best of breed, right? When something like COVID happens, the gut reaction is to say, I'm going to cut all lending, right? Like Ares, Apollo, Colchis, Victory Park, all these guys who traditionally play in private credit all cut the credit line. So you might have seen in the news that it was either Cabbage or Ondex lender basically said, you can't lend anymore. You're stopping all businesses. And then Cabbage said, all right, well, I'm going to time to sell to Amex, basically. So similar situation. But the truth is, if the lender is quality, if anything, you should actually give them more money in these times, because when they lend out that capital as part of their post-COVID vintage, for example, it becomes performing so well that it overtakes whatever pre-COVID vintage was there. So the more money you give them, the better they'll do and the better the portfolio looks over time. And so that's what we're able to do. And so, for example, this one, Wall Street Funding, is a small business lender to middle America, basically. Probably with the highest risk in terms of shutdowns and all of that. And so because we have visibility through the data into how they're performing on a daily basis, we saw their performing rate of like basically people paying within 24 hours go from 91% to 80% to 70% to 60%. Well, we're like, holy crap, like we had a real problem here. And so we continue to give them capital because we believe in their underwriting. And we saw also on a daily basis, their post-COVID vintage was doing better and better every single day, that they continued to lend out capital. And that's how we got comfortable with it. So we ratcheted up some things to protect investors on coverage for losses and things like that. But at the end of the day, we believed in them, believed in their potential, and they've now weathered the storm and they're ready to go out the institutional markets with us on their side. So it's a different narrative that most private credit lenders will tell you, but that's just because they are super, super aggressive at the end of the day. And they just want to make sure that they protect their investments and protect the downside. Versus for us, we're more aligned in terms of incentives to help see them through this process from start to finish.
I got a quick question just for you from a business end. I've had guys that did various lending. Like I remember sitting down with a guy that did cattle to ranchers. And he told me, I said, tell me about the business. And he said, well, there comes points in time you cease being the banker and you start being the partner. Because you give them more money to survive through, because if you don't give them money and they go out of business, you're not going to get anything. And so you're kind of stuck in this scenario where you are having to give them more money to make sure they do get it through so you do get paid. So is that the same kind of thought pattern you were just describing?
Yeah,
but you still have some kind of cut. I mean, y'all still have some kind of, as a business, a cutoff point. Like you're not going to risk more than 7% of all your capital or something like that.
Yeah, exactly. And that's what we did for the one in workout. We just said we can't commit anymore to this, and so now it's time to let the courts and the kind of bankruptcy play out as it normally does. So yeah, very much it reached the point where we are partners, but. The truth is, we are, what you see right now is a piece of the puzzle of what we do, but we're really more of a SaaS company at the end of the day. And so we're hoping and banking on the fact that everyone else becomes the partner and we're just simply the pipes to help them become partners. And that becomes not our problem. So everything you see right now is a means to an end at the end of the day. But yeah, as of right now, we're very much partnered with them every step of the way to try and make sure that they can get from one stage to the next.
Awesome. Nelson, would it be okay to open it up to some questions? Because I've been getting some interesting stuff through the chat privately that I think people would like to ask.
Sure, absolutely.
Larry, want to ask a question?
Yeah, Nelson, thank you for providing all this tonight. It's really interesting, and congrats on your success here. I'm wondering, I know that you mentioned on the private deals especially that you only deal with accredited investors, but I'm wondering whether you and the platform itself are under any regulatory controls and or risks, especially in terms of maybe being considered a bank, having to deal with that regulation. I've got a lot of background noise, so I'm going to mute, and I'd like your answer.
Sounds good. So our legal bills tell me that we're in the clear, given the amount that we spent on it, but I can explain why. So on the retail platform specifically, we are actually contractually pulling the cash flows from all these different lenders and creating a note, a debt instrument off of that. And so we're actually the issuer of the notes themselves. So under the broker-dealer regulations, which we're not for the retail side, if you issue your own instruments or your own investments, then you don't need to be a broker-dealer. So we don't fall into that category. In terms of an investment advisor, we don't have to do that either because we're not making any recommendations, right? Like we're basically just saying, this is everything that we have. You can do your own research, do your own diligence, and that's essentially that. So we are filing everything under Reg D securities. That's where it's accredited investors only, different levels of accreditation. But yeah, so we're fully in the clear from regulatory standpoint. Definitely not a bank. Don't have zero intention of being a bank. Our VCs would kill us if we were a bank. We have a terrible multiple. So yeah, that's sort of the path we're going down. And at the end of the day, like I mentioned, the retail platform very much is a means to an end to everything else that we're going to be doing here and much of what we talked about today. So at that point, it becomes really more of a tech company than it is any sort of financial institution.
Being Reg D exempt, does that technically make you a hedge fund?
No. Also no. Thankfully, not a hedge fund, but yeah.
Cool. What other questions do we have? We can open this up to general questions about anything, everybody. Nelson, I'll give you one. What needs to happen? Do you ever have any desire to go, and you may have answered this before, do you have any desire to go downstream further to unaccredited investors, or can you even go there?
Yeah, you can go there. There's a lot of legal work that needs to go into that. And it's honestly just, it's not worth it at the end of the day, because if it's not our business, right? Like our business is not running a crowdfunding platform at the end of the day. Sure. And so as long as we can get what we need strategically out of the platform in terms of getting lenders in the door, growing them, things like that, then yeah, it's not necessarily worth our time. As much as I'd love to kind of democratize investments for everybody across the board, if you're spending, call it, 25, 30, 40 grand on a $5 million deal on just that, it's probably not worth the headache. And supporting all those investors, and also on the reporting side, to help share with your information with the investor, with the SEC around how it's been done, how it's doing, and things like that. So it's too much at the end of the day. We're probably going to stick to accredited for the time being. Got it. How do people find out about you? Yeah, so it's you mentioned earlier, it's just withcadence.io. Pretty simple. You can take a look. You can see. I can share the screen really quick on that front.
Go for it.
Yeah, we'd love to.
They all want to see it.
All right. So you can see. Let's see. There we go. So here's what we have here. So we've done 149 million at this point, and you can actually get access to all the things that I showed you earlier. So on the originator front, these are the 14 that we have over here, how much we funded them, how much interest has been paid out altogether. You can dive into any of these and you can see the surveillance reporting that we have here. So I can just log in real quick and I'll show you. So all these various different surveillance reports are available for you to access. And there you go. So this is what I was showing on the call, but you can actually see, percentage of portfolio repaying. You can see how much it dropped, right? It actually reached a point where there was 70% of the people were paying. That's it. And it was going down fast. And so as we gave them more money throughout this process, you've seen that improve. And now they're back at 90%, which is pretty much pre-COVID levels, which is pretty remarkable. But we produce these reports automatically daily. And this is a level of transparency you don't get in private credit at all. You can actually pretty much mark to market your investment based on the performance that you see here. And outside of that, just various different opportunities we have available. So logistics factoring, healthcare, pharmacy financing, mobile app factoring. These are all things that we have available. So yeah, take a look withcadence.io, and then I'm really easy to reach. It's just Nelson at withcadence.io if you have any questions. But we'd love to have you guys all check it out.
Cool.
How quickly do you normally fund a deal once you put it on the platform until it's all funded up?
Yeah, it depends on the deal. So we've been biting off a lot more than we can chew, and it's still closing, which is great. But we have some that are just really hot in general. So that mobile app factoring one actually basically stayed the same through COVID, 0 defaults. extremely reliable. And that one closed out in like basically half an hour to an hour for like a $2 million deal. And you have other ones that people are a little more wary of. So for example, during COVID, Mexico and Colombia had a lot of trouble closing because people were just worried about the United States at the end of the day. But that has also returned as they've seen the performance do really well as well. We chose the best lenders in Mexico and in Colombia, and they've been kind of backed by the government in some way, shape, or form. So that in of itself gives people a lot more security at the end of the day.
Yeah, I got a question if you don't mind.
Sure.
Yeah, Nelson, really interesting presentation. I appreciated hearing it. I was just curious about what the terms look like with the notes that you issue. Are they tranched? What do the rates look like? And also with the lenders, how do you determine what you should really be charging them?
Yeah, so it is not tranched. So it's kind of, we take a portfolio level approach. I would say at the size that they're at on the retail platform, there's no need to tranche it because it's not going to help you. At the end, it's either going to be all good or all bad. So we kind of just take a one fell swoop on that. The yield varies based upon how they're ultimately performing, but it's a bunch of sliding scales, a bunch of levers, right? So for example, let's say we have a situation where their default rate is 5%, then we could theoretically also throw on there like a first loss coverage of, for example, 10 or 15%, in which case the portfolio needs to default above and beyond the 5% to be able to actually even have a problem. And in which case, because that first loss cushion is so much more than their default rate, the yield would come down, right? So that the cost is less. But then other instances where you could be subordinated, where there's senior debt above you. So if there's a situation where there's a default, the senior guys get paid before we do, then the yield for that goes higher. So it really is it's a bunch of different levers that we play with here that we try and figure out what the market demand is going to be. But you can reliably expect for us, 8 to 16% is about what we'd offer depending on the asset, the duration, and things like that. So we specialize in short duration investments, 1 month, 3 months, 6 month, 9 month. Effectively, we did our first 1 year one today or a couple of weeks ago. A couple days ago. But the ability for you to kind of get that type of liquidity whenever you want, like a month later, is really powerful. And so we found that investors really like that a lot.
That's interesting. Does the lending term that you provide, does that typically match what the lenders, what their specifications look like? No,
it doesn't. Yeah. So that's the challenge. So we've been able to take long dated assets and turn them into short duration investments. And that is not an easy feat, but we've been able to do it through a bunch of legal work as well as kind of financial work to be able to pull that off. And also some trust from the lender that we're still going to be able to deliver for them like in a month or 3 months time. We're not going to just pull the money. So yeah, it's a combination of all those things.
Gotcha. All right. Thank you.
Yeah.
Cool. What other questions we got? I know you guys still have something on your mind.
So I've got another question. So an investor puts money in one of your products. Can they then sell their, I don't even know what, their stake in that product through the platform? Like they go in, it's a 3 month lock or 3 month deal, and they're 40 days into it and want to exit out. So your platform allows them to buy and trade, and then are options available on your products?
Oh man, we've been asked about leverage for sure, and we have not entertained that as of yet. No, so we do not allow for secondaries at the moment. Reg D actually has a lockup for a year anyway, and so to counteract that, we basically just went for a shorter inherent maturity of you can diversify your portfolio as you wish. If you might need money in a month's time, then split it between like 75% 1 monthers and 25% 3 monthers, and you can allocate it yourself. So that's really, we kind of went around the 1 year lockup our own little way.
And Rob, when he gets options, you'll be the first to know, okay?
I'll email you.
Cool. All right, everybody. Well, I want to say thank you so much for being on. Big thanks to Nelson. Nelson, you're the man. I love that. For everybody else, we're going to just hang out for next 5 to 10 minutes talking about whatever. It's just kind of a more social thing, but Nelson, want to say thank you so much. Everybody else, you don't have to be on anymore, but we just kind of open it up to hang out now.
Yeah, thanks so much for having me, guys.
Yeah, thank you, for sure.
Thank you, Nelson.